The language of digital credit. In a market built on noise, this is structure. Digital credit explained. In the previous episode, we established why digital credit exists. 3 structurally distinct building blocks: Bitcoin as collateral, stablecoins as yield-generating instruments, and Bitcoin-backed structured credit have together created a new credit ecosystem. Today, before we go any deeper, we pause to build the vocabulary that will carry us through the next 178 episodes. Precision in language is not a formality here. It is the foundation of rigorous risk analysis. Every serious discipline has a technical vocabulary. And the reason that vocabulary exists is not to create barriers to entry. It is to eliminate ambiguity. In traditional fixed income, when an analyst says duration, every participant in that conversation understands precisely what is meant. The sensitivity of a bond's price to changes in interest rates. That shared precision is what makes institutional conversation possible. Digital credit is no different. Its vocabulary is specific, and it matters enormously. Let us establish the core terms now. The first and most important distinction in this entire series is between yield and return of capital. Yield is the income generated by an instrument over a defined period, expressed as a percentage of the principal deployed. Return of capital is the recovery of the original principal at maturity or upon redemption. These two things are not the same. Yield is meaningless if the return of capital is compromised. The most dangerous instrument in any credit market is one that delivers attractive yield while silently destroying principal. Throughout this series, when we evaluate any digital credit instrument, the first question is always, what is the probability of full return of capital? Yield is the second question, always. The second critical term is collateral. In credit, collateral is an asset pledged by a borrower to secure a loan. If the borrower defaults, the lender has a legal claim on that collateral. The quality of collateral, its liquidity, its price stability, its legal enforceability, directly determines the safety of the lending arrangement. In digital credit, the primary collateral instrument is Bitcoin, and its properties as collateral are, as we will explore in coming episodes, genuinely distinctive. Third, counterparty risk. This is the risk that the other party in a financial arrangement, the borrower, the platform, the custodian, the protocol, fails to meet its obligations. Counterparty risk exists in every credit market. What varies is how identifiable it is, how measurable it is, and how effectively it can be mitigated through structure and transparency. Fourth, loan to value, universally abbreviated as LTV. This is the ratio of the loan amount to the value of the collateral securing it. If a borrower pledges $100,000 of Bitcoin and receives a loan of $60,000, the LTV is 60%. LTV is a primary determinant of collateral cushion, buffer between the loan value and the point at which the collateral becomes insufficient to cover the obligation. We will examine LTV mechanics in significant depth in later episodes. Fifth, rehypothecation. This term describes the practice of a financial intermediary re-pledging a client's collateral as security for the intermediary's own borrowing. It is a common practice in traditional finance, prime brokerage, securities lending, and it is a significant and often underappreciated risk factor in digital credit. We will dedicate a full episode to it in Phase 3. Finally, for today, on-chain verifiability. This refers to the ability to independently confirm the existence, movement, and custody of digital assets using publicly accessible blockchain data. It is one of the most structurally significant differences between digital credit and traditional credit. And it is the primary mechanism through which the opacity that contributed to the failures of 2020 to 2024 can be reduced. When an analyst can verify collateral balances and reserve compositions independently, without relying on issuer-disclosed financials or third-party attestations, the risk evaluation process becomes materially more rigorous. These 6 terms, yield, return of capital, collateral, counterparty risk, LTV, rehypothecation, and on-chain verifiability, are the conceptual anchors of this series. Every subsequent episode will build on them. Use them precisely. The discipline of language is the first discipline of rigorous credit analysis. Vocabulary is not decoration. In credit analysis, imprecision in language produces imprecision in evaluation, which produces mispriced risk. The terms established today, yield distinct from return of capital, collateral quality, counterparty risk, LTV, rehypothecation, and on-chain verifiability, are not definitions to be memorized and set aside. They are the active operating vocabulary of every episode that follows. The most sophisticated allocator in any room is usually the one who uses these terms most precisely and who insists that others do the same. In the next episode, we take our first aerial view of the three instrument families, examining how each generates yield and why each requires a fundamentally distinct evaluation framework. Clarity before yield, always. Digital Credit Explained.